For many, the answer to that question, the quest for stability and growth, leads straight to the Dividend Aristocrats. These are companies that have not just paid dividends, but consistently increased them for at least 25 consecutive years. They stand as a symbol of financial fortitude, a gold standard for income investors seeking stability in a world of constant flux. The label itself feels like a promise, an unshakable bastion of reliable income. You might feel a sense of calm, a certain peace, knowing your capital is entrusted to such proven performers. A warm wind on your face, a quiet assurance. Yet, this is precisely where we must pause and allow a deeper question to surface. Does this aristocrat status alone truly guarantee safety of principal and a satisfactory return? Or could it, in its very allure, mask deeper, overlooked vulnerabilities that even the most ambitious and sophisticated investors can fall prey to? Benjamin Graham, the sagacious mind behind the intelligent investor taught us that an investment operation is one which, upon thorough analysis, promises safety of principal and a satisfactory return. Operations not meeting these requirements are speculative. His words are a gentle reminder, a guiding star, urging us to question whether our embrace of dividend aristocrats is truly founded on thorough analysis, or if we are, perhaps unknowingly, treating them as inherently safe without peering beneath the surface. This isn't about dismissing the value of consistent dividends, far from it. This is about equipping you with a critical lens, an X-ray vision, to move beyond the conventional wisdom and truly master dividend investing. Rather than simply following a label, we will embark on a data-driven investigation, uncovering 5 hidden mistakes that lurk within this seemingly pristine investment strategy. We're not just looking at the what but the why, understanding the genuine underlying mechanisms. This journey will empower you to discern the true strategies for sustainable wealth creation, distinguishing them from common misconceptions and market noise. Are you ready to deconstruct these narratives and connect complex financial theory to practical, profitable application? We're uncovering the hidden truths behind wealth accumulation, inviting you to challenge the consensus and find your unique edge. There's a silent fear that often gnaws at the ambitious investor, a quiet unease that perhaps the very foundations of their portfolio, built on a bedrock of historical data, might subtly mislead. You pore over charts of past performance, seeing consistent dividend growth, a comforting, unbroken line upwards. This rosy picture, however, can paint a mirage, leading to a profound sense of inadequacy when future returns fail to mirror the comforting patterns of a cherry-picked past. This is the insidious trap of survivorship bias. We often look at the current list of dividend aristocrats and marvel at their enduring strength, believing that their past dividend growth automatically predicts a future of stability. But what we overlook is the fundamental, often hidden, mechanism of index construction itself. The index, by its very nature, only shows us the victors, the companies that survived the economic battles and market storms to retain their coveted status. It doesn't show the countless fallen, the companies that once wore the crown but have since been delisted, acquired, or simply failed to maintain their dividend streak. Think of it like the ancient Greek paradox of the ship of Theseus. If a ship's planks are gradually replaced, one by one, until none of the original components remain, is it still the same ship? Is it truly the same resilient vessel if its fundamental components are constantly changing due to the harsh seas of market reality, rendering its identity as a consistent performer an illusion? Many dividend aristocrats of yesteryear no longer exist in their former glory, fundamentally changing how we should view long-term track record. The index only presents the survivors, a carefully curated garden where wilted flowers are silently removed. To truly discern long-term stability from this survivorship bias, we must adopt a more rigorous, data-driven approach. First, backtest any strategy with constantly updated index constituents, not just the current list, to see how a portfolio would have performed with companies that fell out of the index. Second, analyze the shifts in sector concentration over time, understanding how the underlying economic landscape of the aristocrats has evolved. And finally, compare dividend growth rate versus consistency across different economic cycles, meticulously accounting for those delisted companies that once graced the list. This deep dive into the data helps us understand the genuine underlying mechanisms, separating market noise from the true resilience required for sustainable wealth. Is your diversified portfolio truly diversified, or is it implicitly biased towards a past that no longer exists? There's a deep cognitive dissonance that can settle in the heart of an investor. You've found a company consistently growing its dividend, a true aristocrat of income, and a part of you believes this must signify a good investment. Yet another part, the data-driven part, sees valuation metrics screaming caution. This can feel like a philosophical wound, as market logic seems to betray a seemingly sound strategy. This is the hidden mistake, the valuation blind spot. Many investors, in their pursuit of steady income, allow the allure of consistent dividend growth to overshadow fundamental valuation principles. They prioritize the comforting rhythm of increasing payouts over rigorous analysis of P/E ratios, free cash flow yield, or enterprise value multiples. It's a common distortion, believing that dividend growth alone signifies a healthy *undervalued investment, when in truth, it merely signifies operational strength in the past. The counterintuitive truth is this: chasing dividend growth without regard for the price you pay can lead to buying an asset at such an inflated valuation that its future total returns are significantly diminished. Even if those dividends continue to grow, the initial overpayment acts like a heavy anchor, dragging down your overall performance. An aristocrat bought at any price is, in essence, still a speculative bet, betraying the very principles of prudent investing. As Warren Buffett often reminds us, price is what you pay, value is what you get. To bridge this gap, to heal this philosophical wound, we must adopt a practical transformation, a two-filter approach. First, certainly screen for dividend growth and consistency, identifying those companies with a proven track record. But then, rigorously apply a value investing framework. Use discounted cash flow analysis, compare its valuation to its peers, or calculate an intrinsic value inspired by Graham and Dodd to ensure a crucial margin of safety. This dual lens allows you to seek not just dividend growers, but *undervalued dividend growers. Remember the story of Icarus and the sun. The alluring promise of consistent dividend growth can lead investors to fly to high on valuation, drawn ever closer to an unsustainable price. But just as Icarus's wings melted, the wax of your portfolio can melt when market gravity inevitably reasserts itself, punishing overpayment. We're uncovering the hidden truths behind wealth accumulation. Are you truly seeing the value, or merely the dazzling light of growth? There's a subtle, yet profound, emotional consequence that often accompanies the prestigious Dividend Aristocrat label. It's a form of anchoring bias, where the very status of a company can lead to an overconfidence that whispers, "This one is different. This one is safe." This feeling, while comforting, can wound your decision-making autonomy, fostering a complacency that makes you ignore contradictory evidence or critical financial analysis. You might find yourself unconsciously filtering out warning signs, actively seeking data that supports the aristocrat's continued success, a dangerous dance with confirmation bias that masquerades as prudence. This leads to a shattered expectation, the psychological trap of associating Dividend Aristocrat status with an unshakable fortress, rather than a dynamic company that requires continuous re-evaluation. Our rigid mental models can lag market reality, causing us to cling to a past identity even as the underlying business deteriorates. It's like believing a champion athlete will always win, even as age and injury begin to take their toll. The market, however, is unforgiving of such complacency, leading to poor exits and diminished returns. Let us engage in a symbolic exercise to dissect this bias. Imagine a Dividend Aristocrat stock, one you deeply trust, suddenly losing its coveted status. Perhaps it cuts its dividend, or its core business faces an existential threat. Would your initial reaction be to defend it based on its glorious past, its long history of payouts? Or would you objectively analyze the underlying business deterioration, detaching from the emotional comfort of its former title? This thought experiment reveals the depth of our emotional attachment and the crucial need for detachment in truly data-driven investing. The very act of finding a seemingly safe dividend stock can trigger a dopamine release, a reward for what feels like a wise, secure choice. But this initial satisfaction, this rush of certainty, can hinder your empowered, data-driven decision-making. It can prevent further critical scrutiny, fostering complacency and blinding you to evolving risks. Ray Dalio reminds us of the importance of radical transparency and truth. Are we being radically transparent with ourselves when we allow a label to override our critical judgment? We're challenging the consensus, finding your edge. Are you truly prepared to look beyond the title and see the evolving reality of every investment? There's a quiet unease, a silent dread that can creep into the heart of an investor who believes they've achieved robust diversification simply by investing in a Dividend Aristocrat ETF or mutual fund. You feel the comfort of a broad basket of strong companies, yet beneath this surface lies a hidden vulnerability, a heavy skew towards a few cyclical sectors. This isn't true diversification. It's a silent fear that your portfolio's strength is compromised by a single, focused storm. The myth persists that diversification within a Dividend Aristocrat index alone guarantees safety. In reality, these indices often exhibit significant sector concentration. Think of consumer staples, industrials, or financials. While individually strong, their collective dominance creates systemic risks that a truly broad market index might mitigate. Your diversified portfolio might, in fact, be concentrated in areas highly sensitive to interest rates, regulatory shifts, or consumer spending changes. Risks not immediately apparent from the Aristocrat label alone, a counterintuitive quantitative truth emerges. While consistent dividend growth implies stability, the source of that growth can be concentrated in mature industries. These industries are often highly sensitive to external factors like interest rate fluctuations, specific regulatory changes, or broad shifts in consumer spending. This exposes investors to vulnerabilities that the comforting aristocrat label alone fails to reveal, creating a hidden vulnerability that can sting unexpectedly. To truly transform this understanding, apply a forensic accounting depth to your portfolio. Map the true sector and industry breakdown of your Dividend Aristocrat holdings. Then, compare this against a truly broader market index, like a total market fund, to identify and manage any uncompensated concentration risk. This data-driven approach empowers you to actively rebalance, ensuring your portfolio's resilience is built on genuine diversification, not just a label. Imagine a meticulously built brick wall. Each brick is strong, a testament to individual quality, much like a Dividend Aristocrat company. But what if all those bricks came from the same quarry, susceptible to the same type of weather, the same unique weakness? A single, focused storm, say a specific economic downturn primarily affecting one sector, could compromise the entire wall's integrity, despite the individual strength of each brick. This is the hidden sector concentration risk. We're uncovering the hidden truths behind wealth accumulation. Is your diversified portfolio truly diversified, or is it merely presenting a unified front that hides deeper vulnerabilities? There's a profound philosophical wound that can sting when a long-standing Dividend Aristocrat, a pillar of stability, suddenly cuts its dividend. It's a moment that challenges the very belief in perpetual competitive advantage, making you question the fundamental fairness or logic of market mechanisms. How could something so seemingly invincible, so deeply entrenched, simply falter? This reveals a crucial, often overlooked truth. Even the most formidable economic moats can erode. This leads to a common distortion: the belief that a company's past ability to consistently grow dividends automatically implies an unbreakable economic moat. We often ignore the dynamic nature of competitive advantage, the relentless march of innovation, the subtle shifts in consumer behavior, and the evolving structures of entire industries. The aristocrat label, in these instances, can lull us into a false sense of security, blinding us to the forces quietly at work. The expectation can shatter when we realize the economic moat that once protected a company's cash flows has been silently filled in. New technologies can emerge, fierce competitors can adapt, or regulatory changes can shift the landscape entirely. What once appeared as robust dividend growth can, under this pressure, become an unsustainable payout ratio, a facade that eventually crumbles. It's a powerful lesson in the impermanence of even the strongest advantages. To truly understand the genuine underlying mechanisms, we can draw inspiration from Benjamin Graham. First, analyze the company's competitive landscape with a keen eye, looking for emerging threats and assessing the true strength of its strategic positioning. Second, scrutinize free cash flow trends relative to dividend payouts and capital expenditures. Is the company generating enough cash to sustain these payouts while also reinvesting for the future? Third, evaluate management's capital allocation decisions beyond just dividend raises, looking for wise reinvestment that builds enduring value. Consider the story of a once mighty river. Its consistent flow, its powerful currents, seem eternal. Yet, even the most powerful river can be diverted or dry up if its source, the company's core economic moat, is compromised by a shifting landscape. A steady, comforting flow can turn into a mere trickle. This reveals the critical importance of independent thought, of looking beyond the surface. We're uncovering the hidden truths behind wealth accumulation. Are you truly examining the source of the flow, or merely enjoying the current? Our journey through the landscape of Dividend Aristocrats has revealed that even the most seemingly solid foundations can harbor unseen cracks. Warren Buffett famously said, "Risk comes from not knowing what you're doing." Our exploration today has been precisely about truly knowing what you're doing, not just what you're buying, to navigate the market's hidden currents and build enduring wealth. We've peeled back the layers, moving beyond the comforting label to uncover 5 hidden mistakes. We saw the survivorship bias mirage where past performance, filtered by index construction, became a trap rather than a promise. We identified the valuation blind spot a subtle error where dividend growth masked overpriced assets and diminished future returns. We confronted the behavioral trap of anchoring acknowledging how the prestigious aristocrat status could lead us to ignore crucial red flags. We unmasked hidden sector concentration risks realizing that a seemingly diversified portfolio could still be vulnerable to focused storms. And finally, we examined the erosion of the moat understanding that even perpetual competitive advantages can silently diminish diminish, turning a steady flow into a trickle. These insights reaffirm a profound truth: building genuine wealth through dividends demands a critical, data-driven mindset. It calls for a steadfast commitment to fundamental analysis, a willingness to scrutinize every claim, and a healthy skepticism that looks beyond mere labels or historical accolades. This is about deep intimacy with data-driven truth, understanding the genuine underlying mechanisms, and connecting complex financial theory to practical, profitable application. Now, with this newfound clarity, you are empowered to scrutinize your own portfolios with a discerning eye, challenge the conventional wisdom that often takes root in the market, and avoid the common pitfalls that can derail even the most ambitious investors. This is your transformation from a passive follower of labels to an active, informed decision maker, one who truly understands the why behind every investment. This journey towards financial mastery is a continuous one, a path of independent analysis, critical thinking, and disciplined action. It is a path that liberates you from the illusions of the market, guiding you towards sustainable wealth creation, built on a foundation of profound understanding. Are you ready to embrace this deeper knowing, to look within your own portfolio and ask what hidden truths are still waiting to be uncovered?